Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for WealthPress. Today is Thursday. It is Thursday, the 17th of June, and it is 7:43. The market's going to open up in about an hour and 45 minutes or so. Yesterday, we had a big report, and we had an announcement. The Fed is changing their timeline for interest rates. Very important, which is the first indication that the economy is running hot. Now, before we get into that, I want to show you something interesting. This is the import and export number, right? This is great. Look at the export, because the U.S. exports a lot of products and not services, products. Look at a month over month. The expectation was an increase of 0.2 to 0.8. We saw 2.2 increase in export prices on a month-to-month basis. I think that's what, 150%, 175% higher than 0.8. It's a lot higher. So there's definitely inflationary pressure. The big news, the big report today, as we will see in a minute, is going to be the jobless claims and the Philadelphia manufacturers. The jobless claims is going to be the big one. And the number has been really solid. It's been actually showing us that we went from 800,000 to 600,000, back to 800,000, and then we finally broke 600,000. We went into 400,000, and now we're in the 300s. So the odds are the number's going to be good. It's moving in the right direction. Honestly, anything below the moving average is good. It's been good lately, so even if it's a little off, it's still fair enough, unless it goes back into like the 500-600s. So anything under 460,000 is good. Anything below 370,000 is good. Keep your eye on that number. Now, as far as the markets right now, the Dow, the Nasdaq, we're a little down. I can't really say we're down too much beyond random level. I mean, the Dow's only down 49 points. The Nasdaq's down 47 points, which is maybe beyond random just a bit. But again, based on yesterday's report, I would expect some fluctuations in the market. Now, let's talk about the announcement yesterday, because this is very important. So, Thursday, we're trading lower right now after Federal Reserve indicated it might ease off economic stimulus earlier than previously thought. They changed the timeline a little bit. Fed policymakers on Wednesday estimated their benchmark rate would rise twice by late 2023, earlier than previously forecast of no rate hikes by 2024. And remember, the markets assimilate everything ahead of time. So again, this will cause the bond market to cool off a little bit, and interest rates to start rising. And I believe it'll start happening towards the end of the summer. But they previously said no hikes before 2024. Now they're talking about a rise twice by late 2023. So they have changed the timeline a little bit, and I think that timeline is going to change a little bit more. The Fed indicates that U.S. economy improving faster than expected. Yay! Love it. Let's make sure the world economy recovers faster than expected. The Fed announced Wednesday, reflecting growing confidence in the U.S. economy as more people are vaccinated against the COVID and business activities are reviving. Investors are worried that the Fed and other central banks might feel pressure to withdraw stimulus to cool rising inflation. They're not going to do that. Fed officials have said they believe inflation will be short-lived, a stance they repeated on Wednesday. I sure hope so, because boy, oh boy, this, Fed chairman said, Jerome Powell said conditions have improved enough to start discussing when to slow bond purchases, but they're not doing it yet. The Fed is buying $120 billion a month to inject money into financial markets and keep lower rates low. So again, I think right now the best thing to do is focus on sectors that are not interest rate heavy. The bond market is moving higher, but then it moved a little lower. Overnight, it's a little higher. I still think we're going to stay range bound, maybe go a little bit higher before cooling off. We already know that interest rates that there is going to be tapering, but 2023, they're still kind of vague. I think we're going to go choppy, maybe a little bit higher, maybe just stay around this range. But I think over the next 8 to 10 weeks, we're going to start cooling back down. Because remember, the market always appraises everything in its price ahead of time. As far as the NASDAQ 100, we're still trading above the 50-day moving average, as I showed you guys yesterday. And if you haven't seen this, please review Please review my video from yesterday. Momentum levels are narrowing. We literally, on the SPY, I want to tell you guys something. We made all-time highs 2 days ago. we have like 55% of stocks. I'm going to show you this trading above the 50-day moving average, whereas a month ago we had a much, much higher percentage. I don't want to spend a lot of time on this because I did yesterday. So right now, only 54% of stocks are trading above the 50-day moving average. But let's see here, 2 months ago, let's see here, yeah, exactly 2 months ago, 92% of stocks in the S&P out of 500 stocks were trading above, and now we only have 55, and the prices are not reflecting that at all. Let me just go back to SPY. The prices are still reflecting that. Excuse me. The prices are still reflecting. The prices are still reflecting a very, very bullish sentiment. In theory, prices should be somewhere right around the 50-day or hovering around the 50-day, but I mean, we're near all-time highs. So the market is concentrating its efforts, pay attention, concentrating its effort in a handful of large cap stocks that have a huge market cap. A lot of the other stocks are not nearly as strong as this. So right now, we want to focus on some stocks that don't have a lot of interest rate sensitivity. We want to wait and see what happens with the industrial, financial, basic material, and energy stocks, and tech also, because that if the inflationary stocks go down, tech will go up. If tech goes up, inflationary stocks goes down, or inflationary stocks goes up, tech goes down. It's and I've explained that several times. It's an inflationary play because if interest rates are higher, it's good for inflationary stocks that like basic materials and energy that move up with inflation. But if interest rates go down, it's actually good for tech stocks because then investors can get higher yield or higher payout potentially from tech stocks. So there's this battle between these industrial, basic material, inflationary stocks and non-inflationary stocks. And I want to see how it plays out before making a big commitment over the next few days, before making a big commitment into one of those areas. Now, I do like two stocks that are in the healthcare sector. One is THC. I've talked about this stock, Tenet Healthcare. If you look at this stock, this is a $7 billion company. They are up 200% almost this year. Hospitals, general surgeries, mid-cap, S&P, Russell 2000. I like smaller stocks right now. Multinational investor-owned healthcare service company. Love it, love it, love it, love it. Very neutral towards interest rates, healthcare. And they usually go up when there's like a big question of what will happen with rates. And another one I like is ALKS. Made an all-time high or a swing high. Let's see here. Not an all-time high, a swing high. Several days back, it's trading above the 8-day exponential, the 50-day, and the 200-day line. I like what the stock is doing. And what I really like about the stock is, again, biomed, medical, 46% return. Biotechnical company develops innovative medicine designs to yield better therapeutic outcomes. That's what we want right now. Division of Johnson & Johnson, blah, blah, blah. Schizophrenia use, non-related. Schizophrenia is not going to change whether inflation is up or down. You see what I'm saying? Unfortunately. But that's how it is. The bottom line is be very, very cautious for the next few days. We really don't know what's going to happen right now. If we look at the smaller stocks, if you look at the Russell, they're also showing some vulnerability, but everything is trading near all-time highs. One thing I will tell you, the markets are much stronger looking from the external perspective than they are from internal perspective. Right now, internally, we should actually be pretty neutral. We shouldn't be all that bullish. I mean, look at this. 91 or 92 out of 500 stocks trading above the 50-day moving average, and now only 55. But the market is still representing. I mean, we're still here compared to here. And we have 40% less stocks trading above the 50-day moving average. So there's a huge influx of capital into a handful of large cap stocks right now. The market is not broadly bullish. I want you guys to know that. Now, before I let you go, I got something huge for you. Tom Busby, folks, he's considered one of the top traders and researchers in the industry. So when he said a 4-day window is the most important ingredients for a string of triple-digit winners, it definitely got our attention. It got my attention. Tom explains how the same window repeats every week and what's that delivered some of his best trades of the year. Plus, it completely removes traders' weekend risk exposure. In on Tuesday, out on Friday, which is critical in these volatile markets. Folks, people can spend their weekends reading their favorite book. Man, wouldn't I love to do that? Playing golf like Tom does all the time. Here in sunny Florida, that's what people do. Or grabbing brunch with friends. Man, I'd love that. This past week, Tom's strategy was able to lock in gains of 11.26% on the Dow, on the Diamond, ticker symbol DIA, or the Biotech XBI ETF. How about 30.49% on XBI ETF in like 4 days, 96 hours? How about 48.48% on ticker symbol X? That's a steel company. In 96 hours, all of these trades are 96 hours. In on Tuesday, out on Friday. No over the weekend risk. Folks, I got a question for you. Are you ready to find out how everyday traders just like you can enjoy long weekends without worrying about what will happen on Monday? I hope you're ready. Follow the link below. Check it out now. You don't want to miss out. Tom Busby's the real deal. And folks, make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first notified when I post new videos for you. And have an amazing day. Bye.